To see the capital flows and follow the money, you have to monitor the currencies. My name is Christian Garcia and I'm the owner and founder of BuyTheDips.com. In this video, I'm going to show you how investment capital moves between asset classes and currencies. You will see how everything is connected and how the wealth cycles and capital flows are real. I'm going to primarily rely on the capital flow thesis from Martin Armstrong to prove my point. Remember, in episode 1, we learned that capital flows from one asset class to the next. His website describes it as, and I quote, "Capital concentrates into a single region and then into a single market. There is a cycle to this as well. From within a region, such as the hot market will be real estate, bonds, stocks, commodities, and then back to real estate. What makes a bubble is this concentration of capital. However, every market retains its own cycle, and it is when that cycle lines up with the ECM that we get the big booms and busts." Let me show you another way you can kind of see the global capital flows visually and in full display for the world to see. At least this is how my brain is interpreting what I've learned and what I'm seeing. To see the capital flows and follow the money, you have to monitor the currencies. Let's look at currencies. Let's start with the US dollar. The current version of the US dollar has been losing purchasing power since its inception in 1913, and many people believe and have been touting its demise, including me for a long time, and of course including Mike Maloney and other so-called financial gurus. Let me make this perfectly clear. I still believe the US dollar is going to experience a crash, just not right now and not from these levels. I'll explain more later. But for now, let's define what a crash means anyways. Investopedia defines a crash as a sudden and significant decline in the value of a market. A crash is most often associated with an inflated stock market. Causes for a crash may include an economic bubble in which securities or other investments are trading at prices far above their intrinsic value, or a highly leveraged market in which debt is used to finance further investment. Crashes are distinguishable from a bear market by their rapid decline in a number of days rather than a decline over a long period of time. A crash can lead to a depression in the overall economy and subsequent bear market. Another component to a crash is that a crash starts from making fresh all-time highs up to that point. The great stock market crash of 1929 was from an all-time high. The stock market peaked and crashed. Same with Black Monday in 1987. The market crashed from an all-time high or peak. The dot-com crash was from an all-time high or peak. Same with real estate in 2007. Real estate crashed from an all-time high. Right now, as of this video, everyone incorrectly but understandably believes the stock market is going to crash from an all-time high or peak. My point is that a crash comes from an all-time high or peak. Let's look at the US dollar chart. Just going back 30 years in the chart, you can clearly see that we haven't even exceeded the 2001 high. So how can we have a crash when the dollar is not even at an all-time high? Let's go back further. This chart goes back to 1971 when Richard Nixon stopped the convertibility of US dollars into gold, and the US dollar was allowed to float or find its fair value in the market, or some would say its market value. You can clearly see the dollar's all-time high since that fateful moment in history was back in 1984. So the dollar still has to break through the 2001 high, and its next technical resistance after breaking that previous high or peak is the 1984 all-time high. That's where the dollar is heading, and that's when it will crash. Not before making new all-time highs, and not from these levels. In fact, the dollar has already broken long-term resistance, and that resistance has now turned into support. That's one indicator confirming the dollar is going to get stronger from here. Let me offer some more evidence to back up my opinion. Let's look at the world's top 10 traded currencies. You can see the top 10 traded currencies are the US dollar, the euro, Japanese yen, British pound, Australian dollar, Canadian dollar, the Swiss franc, Chinese yuan, Mexican peso, and the Swedish krona. All of the following currency charts are going back 20 years to 1997, except the Chinese yuan. I believe 1997 is a good starting point because that's close to the time period of when the euro became the European Union's official currency in 1999. Plus, most of us are old enough to remember the time period, but young enough to have it somewhat fresh in our minds so we can have a more realistic feel and understanding of what I'm about to explain. Let's start with the euro, the second most traded currency and the currency that presents the most competition to the US dollar. You can see in 1999 there were high hopes for the euro, but as soon as it became official and started trading, the market let the euro know how the markets felt, and the markets weren't interested in the euro. Not yet. The euro declined into its all-time low in 2001. And that makes sense, especially if you understand the capital flows of the time and the economic climate of that time period. Let's look at the dollar during that same time period. It's the complete opposite of the euro. The dollar spikes into 2002, and that remains the dollar's previous high. Let's see what other currencies were doing. For now, I'm leaving China out of this part of the discussion because it wasn't until the mid-2000s when the yuan or renminbi started trading freely. During the early 2000s, the yuan was not trading freely in the exchanges and was fixed by the Chinese government, as you can see by this chart. But let's go back to 1999 and look at the British pound. It trended the same as the euro. The Japanese yen made a low in 1999, but spiked with the dollar before falling again until 2002. The Australian dollar followed the euro's path and declined into 2002. Same with the Canadian dollar, it declined. Same with the Swiss franc, it declined. And the Mexican peso has done nothing but decline since 1999. The Swedish krona also followed the rest of Europe and declined into 2002. But what caused this major dollar peak and worldwide decline in the majority of the world's currencies? The dot-com bust. Remember, the stock market crashed in 1998. Look at the Dow. Look at the British stock market, the FTSE or FTSE, or the DAX from Germany, or the Nikkei from Japan. You get the picture. It was a worldwide event, so the world investment capital sought a safe haven, and that was the US dollar, mixed in with some yen. But curiously, the trends reversed for those currencies in 2002. What happened in 2002 that caused a major worldwide reversal? In order to cause a major shift, a major event has to occur to get the majority to act. Just like every crash creates a response, so can so-called black swan events or unforeseen events. The 2002 response can be labeled a black swan event for the public at large. And that event was 9/11. 9/11 signaled to the world that war was coming. A big war. A big expensive war. And in 2002, the US presented its case to go to war and confirmed it would be waging war. Seasoned investors had seen this picture before. Remember Vietnam? The out-of-control spending and war costs led to President Richard Nixon delinking the US dollar from gold in 1971.
The third indispensable element in building the new prosperity is closely related to creating new jobs and halting inflation. We must protect the position of the American dollar as a pillar of monetary stability around the world. In the past 7 years, there's been an average of one international monetary crisis every year. Now, who gains from these crises? Not the working man, not the investor, not the real producers of wealth. The gainers are the international money speculators. Because they thrive on crises, they help to create them. In recent weeks, the speculators have been waging an all-out war on the American dollar. The strength of a nation's currency is based on the strength of that nation's economy. And the American economy is by far the strongest in the world. Accordingly, I have directed the Secretary of the Treasury to take the action necessary to defend the dollar against the speculators. I have directed Secretary Connally to suspend temporarily the convertibility of the dollar into gold or other reserve assets, except in amounts and conditions determined to be in the interest of monetary stability and in the best interest of the United States. Now, what is this action which is very technical. What does it mean for you? Let me lay to rest the bugaboo of what is called devaluation. If you want to buy a foreign car or take a trip abroad, market conditions may cause your dollar to buy slightly less. But if you are among the overwhelming majority of Americans who buy American-made products in America, your dollar will be worth just as much tomorrow as it is today. The effect of this action, in other words, will be to stabilize the dollar. Now, this action will not win us any friends among the international money traders. But our primary concern is with the American workers and with fair competition around the world. To our friends abroad, including the many responsible members of the international banking community who are dedicated to stability in the flow of trade, I give this assurance. The United States has always been and will continue to be a forward-looking and trustworthy trading partner. In full cooperation with the International Monetary Fund and those who trade with us, we will press for the necessary reforms to set up an urgently needed new international monetary system. Stability and equal treatment is in everybody's best interest. I am determined that the American dollar must never again be a hostage in the hands of international speculators.
And when the dollar was allowed to trade freely, it dropped into 1979. That's what propelled the investment capital into commodities and allowed gold and silver to hit all-time highs. And again, you see a reversal in trend in these assets in the same year. What major event happened? Interest rates peaked, and the president of the Federal Reserve at that time, Mr. Volcker, announced that interest rates were going to start declining or going down. Again, seasoned investors had seen this picture before. War was coming, and so were lower interest rates, and this was going to devalue the US dollar. 9/11 in 2001 was the major turning point of capital flows away from the US dollar and into other currencies. You can see that transition clearly as the dollar dropped from 2001 until mid-2004, rallied a little bit as rates increased, but then dropped again as rates dropped again until mid-2008. Now let's look at the other currencies. The euro rose from 2002 until 2008. Same with the British pound, same with the Japanese yen, same with the Aussie dollar, the Canadian dollar, the Swiss franc. Heck, one could argue this was the best time period for the Mexican peso as it remained steady. The Swedish krona also went up from 2001 to 2008. And now we can even see that when China allowed its currency to float in the 2000s, it also rose until 2008. And even though it's labeled on Wall Street as a commodity, some would argue that gold and silver are currencies as well, and no wonder the 2000s were very good for them. 9/11 helped devalue the dollar, making investors go towards other major currencies, including the ultimate currency, gold and silver. Again, another major turning point for these currencies. This time in 2008. What happened in 2008? We know. Now we're entering more recent history and something we all should have some kind of emotional feeling towards and recollection, and that's the 2008 Great Recession. It wasn't great, and the years that immediately followed it weren't so much better. Times are better now for some, but there's no doubt in my mind some people still haven't recovered from the 2008 crash and the Great Recession that followed. And the crash was so severe and affected the investment class as well that the dollar became the safe haven. Along with US bonds, you can see the yields deepen severely as investors rushed for safety in the aftermath of the subprime crisis. But the dollar rise was only temporary because, again, commodities peaked up until 2011. Capital was looking for the next wealth transfer and had its eyes set on China. Its GDP started ticking back up, and many were hoping it would get back to its pre-2008 levels, but didn't. The yuan went sideways in an obvious controlled manner, but it gave comfort to investors looking to get out of the US dollar because, after all, the crisis originated in the United States. For a while, the Aussie dollar and the Canadian dollar went up with China as the commodity-related trading partners saw capital flow their way. Investors were hoping that this spike in China's GDP and currency was indicating China was ready to be the next financial hub and wealth transfer. However, not the same trend with other top currencies. You can see the seesaw in the US dollar for a couple of years after 2008 and other currencies. There was no obvious trend or obvious currency play. 2008 to 2013 were really speculative years as the Federal Reserve used all its weapons to try to reflate the US economy. But by 2013, you can see that it became obviously clear to investors that China and the yuan wasn't the next wealth transfer. At least not yet. GDP was no longer going to be in double digits and was decelerating. The markets finally received clarity in 2014 of where capital should be flowing. On February 3rd, 2014, Janet Yellen was confirmed as the chairwoman of the Federal Reserve. This was part of the confusion. There had been speculation that Ben Bernanke would not commit to another term, and this created uncertainty about whether or not his policies would remain in place or if there would be a change. And Janet Yellen's debut was used as the platform to send a message to the investment community that the ZIRP, or zero interest rate policy, was over. Interest rates were going to start going up. As the Wall Street reports, Yellen debut rattles markets. Wary investors seize on new Fed chief's mixed message on pace of rate increases. Investors bristled after Janet Yellen emerged from her first meeting as Federal Reserve chairwoman with some unsettling signals about the central bank's outlook for short-term interest rates. The Fed intends to keep short-term interest rates near zero into next year, but investors sniffed out signs that rate increases might come a bit sooner and be a touch more aggressive than expected. This was huge. As mentioned before, the bond market is the biggest market of the three main asset classes. And with an almost 40-year bull market now officially over in US bonds, disaster is soon to follow. Let's look at this graph again. I mentioned earlier that the bond market is so huge that if only 10% of the capital invested in the bond market rotates to the stock market, that's about $16 trillion. That $16 trillion is equal to 25% of the stock market. So if the bond market crashes just 10%, that's equal to wiping out 25% of the stock market. If the bond market crashes 20%, then that's equal to wiping out 50% of the stock market. That's what happened in 2008. The stock market crashed from 14,000 to around 6,600 points, just over 50%, 54% to be exact. That type of crash resulted in the Great Recession. But most crashes are more than 20%. Let's look at the history of the stock market crashes. You can see the top 11 crashes average out to 49.2% loss. The real estate crash of 2007 saw prices crash 50%, again along with the 54% stock market crash. This means it's not unrealistic to see a bond market crash of at least 30%. If that were to happen, that would equal to wiping out 75% of the stock market. Plus, we know real estate is set to crash by at least 25% if you've seen my real estate 2017 peak video. The Dow reaching 32,000 to 40,000 points is definitely possible with the wealth transfer from the real estate and bond crashes to stocks and US dollars or cash. So where is the money flowing to? You know by now. Capital flows are going to the United States and have been coming here. And the preferred asset class is the stock market via US dollars. That's the current wealth cycle. In 2014, when Janet Yellen hinted that interest rates were going to start going up, the smart money accepted it and acted on it quickly. Let's look at the currencies again. I'm leaving the dollar on the top of the screen so you can see the recent run up in the dollar. Let's start comparing the currencies. Look at the euro. 2014 clearly is the transition point in the capital flows and trend. Same with the British pound, same with the Japanese yen, the Australian dollar, the Canadian dollar, the Swiss franc, albeit less severe but still declining against the US dollar, The Mexican peso decline accelerated in 2014, and the Swedish krona also started its decline in 2014, and finally, yes, even the Chinese yuan has been declining against the US dollar. Again, look at the US dollar. Since 2014, the US dollar has been gaining in value relative to the other top currencies. You can easily see the trend when you overlap the euro. This is an example of Mike Maloney's valuation channel. You can see the capital flows just by looking at the charts. Keep in mind what Martin Armstrong said about capital flows. Capital concentrates into a single region and then into a single market. So we can see clearly that the capital is flowing to the United States, into the US dollar, and the preferred choice of investment has been the stock market. Just look at the two charts of the US dollar and the stock market. The capital is concentrating here in the US and the stock market. The crowd is always wrong. Right now, a lot of analysts, bloggers, and media pundits are calling for a stock market crash, and that gold and silver are the place to be. They've been saying that for years, even though precious metals have been falling while the stock market has been climbing. That's why I'm trying to show you the capital flows and sequence of asset class cycles. I do not want anyone to get burned again. As interest rates rise, real estate will start to decline. So will bonds. The capital flows will go into the US stock market and US dollar. The higher interest rates go, the higher the stock market will go, more capital flows will go to the US dollar. This will put so much pressure on global currencies and their bond markets that, like in the Great Depression, the US government will intervene. They will have to devalue the dollar. And the US has intervened before. Remember, President Franklin D. Roosevelt put an embargo and nationalized gold in 1933. Then he revalued gold from $20.67 to $35 an ounce. That is government intervention to the max. This was not simply a gold revaluation, it was a dollar devaluation. The dollar was basically devalued by 69%. It took 69% more dollars to buy the same amount of gold. Remember, Richard Nixon also intervened with the dollar back in 1971. Who knows what the intervention will look like, but there is no doubt that this will require an intervention. The collapse of the global bond market is going to wipe out a lot of people and financial institutions in the US and the world. The crisis will start first in the international bond market since they are in negative interest rate territory while the US is increasing interest rates. People rationally will start getting out and have been getting out of the negative international bonds and into higher yielding US bonds. And as people flee the international bond markets and redeem them for cash or US dollars because again the international currencies are declining, they will be going to stocks as illustrated earlier, but a big huge rush will also go towards the safe haven of the good old US dollar. You can use the dollar to buy stuff, but you can't use bonds. Plus, it will make more sense to save in dollars than buy a negative yielding international bond or save in dollars if you're in a country whose currency is declining. Investors will start redeeming their depreciating bonds or liquidating them in exchange for US dollars to preserve their capital and purchasing power. This increase in demand for US dollars will put further pressure on global currencies, and as global currencies go down further, the more they're going to switch into dollars, and this will be a vicious cycle into dollars. But the Fed can't just print $10 trillion, can they? Well, they could, but I bet once a run on bonds begins and the US dollar starts getting too strong and a run on cash starts, then that's when the system will go digital. The Federal Reserve and government could use this event to make us go 100% digital. Why print when you can use the phones or watches people already have? Think about it. A strong US dollar is going to be the problem, not a weak one. A strong US dollar is going to destroy a lot of foreigners as their local currencies lose value. Everyone is talking about the demise of the dollar,
But there's a whole planet out there with other countries and nations, and their currencies can't hold a candle to the US dollar. Those currencies will collapse first before the US dollar. As interest rates keep going up in the US, the dollar looks more and more attractive than its next competition, the euro. Think about it. The euro is declining and paying negative interest rates or providing negative yields. Who wants that when you have a US dollar appreciating and paying positive interest? I'll take that all day. Any rational person will always want an appreciating currency paying positive interest rates versus a depreciating currency charging negative interest rates. Higher interest rates in the US is a big factor that will contribute to the US dollar going up. But there's another more sinister reason that can really make the dollar shoot up and will accelerate the concentration of dollars here in the United States. World War III or something close to that. Maybe that's why Donald Trump backtracked on calling China a currency manipulator, because a future revaluation or devaluation is in our future. There's a lot of stake here.
The United States and China, perhaps the most consequential relationship in the world today. But if that's the case, then what's at stake? Let's start with the standoff on the Korean Peninsula. Both China and the United States agree that North Korea's nuclear weapons program is bad news. They disagree on how best to stop it. The U.S. thinks China should use its economic leverage to force North Korea to halt its testing program. China says the only way to solve the problem is if the U.S. directly negotiates with the regime. It's a situation where tens of millions of lives are at stake. How well China and the U.S. can work together is key to solving the crisis. Next, consider the Chinese and American economies, combined worth about 40% of global GDP. They are inextricably linked, with hundreds of billions of dollars in goods traded each year. But any barriers to that trade would mean that both economies would suffer, and that in turn would hurt the global economy overall. Finally, let's turn to the South China Sea. Over the last few years, China has aggressively built up artificial islands, extending its military capability far beyond its own borders. In response, the U.S. has sent warships near Chinese claimed territory. So, will China continue its expansion? Does the U.S. draw a red line in response? The answers will help shape the future of a volatile region.
Did you hear that? 40% of global GDP is tied to the US and China. There's no doubt in my mind that besides the issues mentioned in the video, Russia was a major focal point. So much of a focal point, in my opinion, that while the president of China was here on US soil, Trump launched missiles into Syria and used the "they use gas" excuse. This was such a huge power move. This was the US basically putting China in the hot seat and forcing them to decide who they will support and back up. This was just business, but with street mentality. It's the US basically saying, hey, we're going to do a hostile takeover. I need to know, are you on our side? Are you our partner or theirs? Or like they do in the streets.
So long, Syria. What about China? Want to build our stuff or not? Sure, Trump. Chocolate cake time.
Hey man, you got a job, huh?
Hey, Trump. Covfefe?
Lesbian.
Now, there's only 3 ways this played out. China chose the US in order to try to maintain global economic stability and partnership, thereby simultaneously sending Russia the message they're on their own if war breaks out. China told US officials they will be choosing our side, but are lying to us and will really be Russia's ally, thereby giving Russia some kind of false confidence. Or number 3, China flat out were honest and said that they chose Russia. Again, thereby giving Russia some kind of false confidence if war were to break out. Again, this is my speculation of how the whole semantics of their meeting played out. I don't want to start any international affair here. I'm just speculating. But a huge conflict like this would make the US dollar go up in value because of the real fact that global stability is on the rocks. This is different than the Vietnam War or the war on terror after 9/11, where the world order is not being threatened, so the dollar devalued. The dollar rose at the onset of both world wars because global investors wanted to preserve their capital and chose the US dollar and the United States as the best safe haven and most likely to survive. Major war conflicts between major powers possess the biggest risk to financial survivorship next to financial collapse brought on by a natural boom or bust cycle. If war is breaking out, naturally you will hope nothing happens to you and your family and to bring as less destruction and death as humanly possible. But next comes making sure you survive financially because you're obviously hoping life goes on for you. So what do you put in your financial kit? If you want to survive this event, you must make a choice, just like what I believe China was given regarding Russia. So whose side are you on? And this brings the opportunity for speculation or betting who's going to win and then placing your bets or assets on that side of the bet or trade. Remember, Richard Nixon blamed the international speculators for his intervention and protection of the US dollar.
I am determined that the American dollar must never again be a hostage in the hands of international speculators.
They've done this quite a few times throughout history and bankrupted a lot of people. Well, those international speculators are now on the side of the US dollar. And be careful with those international speculators. They've done this quite a few times throughout history and upset a lot of people. So much that even Hitler had to call them out as he was trying to help Germany recover from their great hyperinflation.
Der Völkerstreit oder Hass untereinander, wird gepflegt von ganz bestimmten Interessenten. Es ist eine kleine, wurzellose internationale Clique, die die Völker gegeneinander hetzt, die nicht will, dass sie zur Ruhe kommen. Es sind das die Menschen, die überall und nirgends zu Hause sind, die nirgends einen Boden haben, auf den sie gewachsen sind, sondern die heute in Berlin leben, morgen genauso gut in Brüssel sein können, übermorgen in Paris oder mit in Prag oder in Wien oder in London und die sich überall zu Hause fühlen. Es sind die einzigen, die wirklich als internationale Elemente anzusprechen sind, weil sie überall ihre Geschäfte betätigen können. Aber das Volk kann ihnen ja nicht nachfolgen. Das Volk ist ja gekettet an seinen Boden, ist ja gekettet an seine Heimat, ist ja gebunden an die Lebensmöglichkeiten seines Staates, der Nation.
I'm not calling President Trump a fascist or a Nazi. I actually hope he does make America great again, and I'm willing to give him a chance. But what I am trying to portray is that he could easily or unwittingly help the international speculators or the international clique or the Democrats by engaging in a war. A major war between major powers. So war is not outside of the realm of possibility. Hopefully war doesn't break out, and that's what I'm praying for. But either way, higher interest rates will lead to a higher dollar. A war is not needed for this to happen. A war is not needed for the dollar to continue its rise. A major war between major powers will simply propel the US dollar even more. Throughout all this, gold and silver will play the role, but not yet. We're close though. While I was at goldsilver.com, I sent an email to Mike Maloney and his confidants on June 15, 2016 about an important occurrence in the precious metals market. During my tenure at goldsilver.com, I would stay up late and wake up early so that I can place the overnight trades done on our website. And I happened to be up watching the market when I wrote, At 11:11 p.m. Pacific Standard Time, we exceeded gold's 2015 high of $1,307. We hit $1,310 so far. On January 22nd, 2015, gold reached 1307 but closed at 1302. So far, we have not closed lower than gold's 2015 low of 1,045 achieved on December 3rd, 2015. So we close out the rest of the year with gold higher than 1,045. We will have stopped making lower lows, and this could be confirmation of the bottom of this 5-year downtrend. Same for silver. I still think gold and silver will correct, but it will be interesting if gold and silver can stay above their 2015 lows for the rest of the year. Anyways, just excited and sharing. Good night and good morning. So yeah, I was excited because that was one of the indicators I had been waiting for to confirm that this bear market in precious metals is over or close to it. Let's look at gold so you can understand what I was referring to. If you look at the 20-year view of gold, you can clearly see that it peaked in 2011. Let me zoom in. This chart goes back 7 years, just enough to get a good view of the gold price since 2011. The definition of a bear market is making lower highs and lower lows. If you look at the market in year-by-year segments or fragments, you can see that is exactly what has been happening with gold. It made lower highs until the end of 2016. It also made lower lows until the end of 2016. Still viewing the market on year-by-year fragments, you can see that the high for gold in 2015 was just past the 1300 level. So what I was mentioning to Mike was that for the first time in almost 5 years, we exceeded a previous year's high. This is important because it is the first indicator and resistance level that has to be broken in order to change trend direction. The next high gold would need to pass is 1400 from 2014, then 1700 from 2013. And this makes sense because if the market is going to recover, it naturally has to break those barriers. This is exactly what you see in the stock market. This is a clear V recovery. It took 4 years for the stock market to reach back and surpass the 2008 highs. So gold will do the same as it naturally starts to recover in price. It has to start breaking prior highs, and to me the 2016 June occurrence in the gold price was the indicator I was looking for. Gold will have its day and it's coming, but not yet. If you place the trend lines in for gold, you can see that gold is hitting against resistance. It can still correct down to 1,045, especially in a strong dollar cycle. Meanwhile, you can see again that the dollar has broken its long-term trend line while gold is hitting resistance. The dollar has to make new highs, triggering a new monetary system before gold and silver will peak again. Obviously, you want to get into gold and silver before the change in the monetary system, but there are other indicators that need to occur before I'm going to make the switch from the stock market into gold and silver.
As a BuyTheDips.com subscriber, you'll get my alerts of when I'm making my moves. Don't be fooled again like those real estate investors in 2007 or the gold and silver investors in 2011. Take advantage of the cycles. Here's the roadmap from 2017 to 2020, alright? Listen up. Up until at least the end of 2017 and 2018, the public should be invested in stocks. Everyone believes the stock market is about to crash, but they're wrong. The public is always wrong. Stocks is where the wealth transfer is accumulating. The stock market should at least double from 21,000 points to 42,000 points. Real estate is the next crash, not stocks. See my other videos showing confirming indicators that real estate has peaked. Plus, with interest rates rising, this will lead to and culminate with a bond market crash, sending the dollar soaring to new highs as a run on cash or US dollars rush begins. At the same time as the dollar is getting stronger, this will put more downward pressure on commodities like gold and silver and set up the best buy the dip opportunity of a lifetime. We have to remain disciplined and not get ahead of ourselves and wait for the indicators to switch between asset classes. Yes, the dollar is going to crash eventually, as I explained in a different video, and gold and silver will do great and more than double from where it's at right now, as I also explained in a different video. But first, the dollar must rise along with the stock market. That's where the capital is heading and has been accumulating currently. We have to get the sequence of these collapses correct. The dollar rise will also break the global currencies. The dollar has to make new highs, triggering a new monetary system before gold and silver will peak again. Obviously, you want to get into gold and silver before the change in the monetary system, but there are other indicators that need to occur before I'm going to make the switch from the stock market into the gold and silver. I will discuss this more in detail with my subscribers at buythedips.com in the members area, so we can go through these two flips and doubling periods successfully and accurately. Just an idea, my real estate and mortgage clients outside of buythedips.com are cashing out of their homes or investment properties and piling into the stock market. Once the stock market peaks and real estate prices and precious metals are lower, you can make the switch back to commodities like gold and silver or real estate for some cash flow and continue riding the wealth cycle. Another possibility is you could just pay back your cash out loan and reduce your mortgage and pay it off sooner. It's up to you. Cycles breeds opportunity. And if you act quickly, you can take advantage of this cycle and buy the dips. Go to buythedips.com to subscribe and learn what I know and what I'm doing to take advantage of this situation. And if you want an individualized mortgage consultation, please visit my other non-affiliated site, homeloancycles.com, and register there. Thank you for your time and be well.